Good evening, ladies and gentlemen. Thank you very much for giving your time to be with us this evening, the SGX, with a important part to play in the See Us Invest Week, which is coming to a conclusion very soon. And we also thank UOB Kai-Yun for being here as well. My part in this evening's presentation is really to take about 20 minutes or so to share with you what we have been doing on SGX My Gateway and investors such as yourself over the last year, more so I guess in the last 3 months or so, what we intend to be doing going forward for the remainder of the year, and what some of this work that we've been doing in conjunction with our broker partners and of course See Us, what this makes, what role I guess we're playing in this in terms of the products and the stock and products in terms of the stocks and the sectors and the various portfolio products that are traded on the SGX. So what we are effectively doing is running a sector by sector, quarter by quarter education series. And this is obviously we've been doing this in conjunction with See Us, so we've been working with See Us quite closely throughout 2013, and we'll continue to do so. And what I guess I'm bringing to the table is just some clear educational examples of how some of this sector diversification can be applicable to investment portfolios. There's a good reason that we're here, obviously. As you know, when you look at where Singapore is now and where we are in terms of the financial conditions or the macroeconomic environment, we do have a very stable currency. We do have very low inflation. We do have, very low interest rates in the banks, and we have a moderate degree of inflation. So, from a financial macroeconomic perspective, there certainly is an environment that is conducive to investing more. So much so that the International Monetary Fund basically provide a country report for all these countries on an annual basis. And they make forward estimates in terms of how much the population will be saving, how much the population will be investing over the next coming 3 to 5 years. And if you look at the country report for last year, you can see that in Singapore, we already do have a very high savings rate, but we're expected to see that savings rate come down marginally, while we are expected to marginally increase our private investment. So much so that GDP is around 260 billion US dollars thereabouts in Singapore. We're expected to increase our private investment by 1.1%. So that's almost 3 billion US dollars worth in the next 3 to 5 years, while we are saving slightly less. So if we are going to be investing more in Singapore, we obviously have to look at various types of assets that you can invest in. Now, there's a multitude of assets. There's obviously not just the stock market itself, but there's obviously mutual funds, unit trusts. There's also, of course, the housing market. And I think if I just take these two asset classes, stocks and the housing market, and look at how those two asset classes have performed in the last 10 years, that you would obviously want to consider whether you're going to start reinvesting. Look at the housing market over the last 10 years. If you look at the Urban Redevelopment Authority Property Price Index by residential type, look at the average annualised return of this index that's released on a quarterly basis. As of the end of the March quarter of this year, this index had returned approximately 6.4% on an average annualised basis each year. That's not to say that the index moved up 6.4% each and every year. It's more to say that on an average basis, smoothed out basis, the property market grew by 6.4%. If you run the same analysis for the Straits Times Index, that benchmark barometer, I guess, of the stock market that takes into account the 30 blue chip stocks, the average annualised return of the STI over the exact same time period was 10.4% on a price performance basis. That doesn't take into account the average of 3% dividend yield that would have been achieved year on year as well. So you have two obviously distinct property classes, with one obviously producing, when taking into account dividends, one being the stock market producing twice as much return as the housing market, but nonetheless, as we said, that's not to say the stock market returned 10.4% each and every year. In fact, 2 years of the last 10 years, it produced a negative return. So if investors are going to be investing more, and let's say with these comparative returns, investors do start to look to invest more in stocks, then what we are trying to achieve here through our educational events and engagements with the partners such as CS and our brokers is to provide some education on the different sectors, because if you are going to be investing more, you probably want to be doing it on a reasonably safe basis. That is, you don't want to be investing too much of your money in one stock which might end up being the underperforming stock of the market in the year. Thus, one of the key, most elemental ways to approach the stock market would be to diversify your investments over the different stocks representing different sectors. It's a key elemental way of basically reducing that concentration risk of ending up at the end of the year with the most underperforming stock. It's akin to not putting all your eggs in one basket, spreading the eggs over very different baskets. And would you believe, in Singapore, we have one of the world's most diverse stock markets. If you look at the top 10 stocks by turnover on a day-to-day basis, those top 10 stocks by turnover represent at least 5 to 6 different sectors. If you look at the next tranche of stocks, I guess, the top 180 stocks, the stocks that make up what we call the Footsie All-Share Index. Footsie All-Share Index is, you might think of it like the S&P 500 for the STI, which you might think of as the Dow Jones. So you're looking at the broader index with a much wider scope of companies. Now, this 180 stocks that make up the Footsie All-Share Index also make up 12 very different, distinct, diversified sector indices that represent such things as financials, utilities, oil and gas, real estate investment trust, healthcare, and so forth. So these 180 stocks represent 12 different sectors. If you want to look at the entire spectrum, look at the entire 700 plus stocks that we have listed on the Singapore Stock Exchange, you'll see that of those 700 or so stocks, we have at least 150 different types of businesses represented by that entire spectrum of stocks. So as we said, we're very diversified. And if you want to see how applicable this diversification is, let's consider those 12 sector indices that also make up the stocks of that all-share index. Look at the performance of those sectors and stocks over the past 10 years or so. I see a few people taking photos of this slide, and if you would like a copy of it without all the glare and so forth, please email me. It's easy. It's just Jeff with a G, geoff.howie@sgx.com, and I'm more than happy to send you a copy of this slide tomorrow. Unfortunately, it's just too colourful and sort of too big to include on our gateway site, but we should do that sometime soon. But nevertheless, it gives you a clear picture. As we're moving into 2013, I might share with you that some of the best performing sectors in the 2013 year to date have been the basic materials sector, the utility sector, and the REIT sector. So two of those sectors we're looking at in a little bit more further detail in the next 5 or 10 minutes or so. I'll just suffice to say that you can see a very clear distinctive difference in the different performances of the stocks. Consider last year that the real estate development and holding sector was up 56% versus the consumer goods sector, which was down just under 18%. What we did in terms of making the point of diversification and providing an educational example, in the first quarter when we were looking at the oil and gas sectors and the telecommunications sector, we basically took and measured the results of last year of taking a balanced portfolio in the biggest stock of telecommunications, that is Singtel, the biggest stock of the oil and gas sector, that is Keppel Corp, and the biggest stock of the consumer goods sector, which was Wilmar. And lo and behold, Wilmar was the most underperforming stock of the most underperforming sector last year, that consumer goods sector, as illustrated in that chart. Now, because the investor had balanced the portfolio, approximately around 33%, there, give or take a percent or two, on each of those three stocks, the investor actually returned, I think, 0.1%, not including transaction fees in 2012. That includes dividend distributions as well. So while there was no, obviously, significant return, it was essentially flat. The example is there to show you that by choosing three stocks from three different sectors, you're able to diversify and reduce that concentration risk of having the one underperforming sector, and reduce the impact of having that one underperforming stock of an underperforming sector. But what we're going to talk about tonight very quickly, for the next 5 minutes or so, is real estate development holding, REITs, utilities and consumer services. So we've taken all the other sectors out of the history of the sector indices, and as you can see, over the last 10 years, real estate development holding and utilities have both been the outperforming sector for 3 years each. So of the 6 of the last 10 years, these two sectors have basically outperformed the market. As you can see, in some cases, they've also been the big underperformers of the market in 2004, 2003, 2007, 2011. So, as we say, and I just want to reiterate this point, that these are just educational examples. Obviously, I'm an education specialist at the Singapore Exchange, and obviously we're not making any recommendations and so forth on particular stocks and sectors, and far from that. Rather, we're just looking at how diversification works in terms of the stocks that we have in the past. So, unbalanced portfolio. Essentially, there's two ways to take a portfolio. The first way is to build shares without a pattern or without a balance in the size of those shares to other shares that are representing different sectors. If you were to take an unbalanced portfolio, taking the three largest stocks of the consumer services sector, the utility sector, and the real estate sector, in the 12 months to March 2013, investing 1,000 shares, the minimum board lot size, in each of those three stocks, each of those three sectors, the largest stocks for each of those three sectors, the return would have been 11.3%. The largest stock, as we said, Jardine Cycle and Carriage is the largest stock of consumer services, Hiflux is the largest stock of the utility sector, and Hong Kong Land is the largest stock of the real estate sector. So as you can see, the total return was 11.3% with an initial outlay of just under $60,000 required to take the investment. However, if you were to take the more balanced approach and basically try and match the size or the notional value of the investments in the two other sectors to the biggest notional value based on the minimum board lot size of 1,000 shares, you can see that your outlay would be increased almost 3 times. Your outlay now requirements just under $150,000, predominantly because Jardine Cycle and Carriage is trading around $50, and thus the minimum board lot size of 1,000 shares makes it an expensive part of the portfolio. So in this case, with the balanced portfolio, the return was 12.8% in the 12 months ending in March 2013. As you can see, two sectors actually performed with a positive return, real estate and consumer services, while utilities made a marginal decline over the 12-month period. But the balancing is an important point, because if you go back 12 months prior, the 12 months ending March 2012, which was different. Remember, 2012, the STI returned 19.7% on a price performance basis. In 2011, the STI was down 17% in terms of price performance. So you have 2 very different years, and thus we're extending this analysis back to 2012 that 2011 year with the first quarter of 2012. So over those 12 months, ending in the quarter of March 2012, you can see that Jardine Cycle and Carriage produced a return, utilities didn't, and real estate sector didn't either, through the most biggest capitalised stock of each of those sectors. So the outlay was $108,000 to establish the position, and the total return was -3%. However, as you can see, had you invested purely in real estate, had you invested purely in utilities, the return would have been a lot less. If you obviously had picked consumer services, the return would have been more, but you also would have increased the risk of choosing the underperforming sector. Say Jardine Cycle and Carriage had moved the other way. So essentially, we're showing the example of just how diverse some of the performances are of the biggest stocks of each sector. And also applies within the sector. Within each sector, you have a number of subsectors. You look at the real estate index, or the real estate stocks that we have. There's two sides of the real estate stocks, two core sides, the real estate developers and the real estate investment trusts. Two very different asset classes in terms of investing. In fact, one's made of corporations, the other is made out of trusts that are governed by the collective investment scheme. So they're very different in terms of what they offer the consumer. The real estate investment trusts are basically property assets that you will be investing in for the cash flow that comes from those property assets, the income that actually is generated, the revenue that is actually generated for those property assets. You see, REITs have a policy where they must distribute 90% of their cash flow, net cash flow, to unit holders, akin to shareholders, on an ongoing basis. Thus, it's a very different investment to putting the investment into the real estate developers, the holding companies, the investment services companies. We have 23 REITs in total on the market, on the stock exchange, and we have 3 stapled securities, which are basically a real estate investment trust plus a business trust together, and we have 4 or 5 property business trusts as well. The slide is just basically showing you an example of how you might establish a diversified real estate portfolio, taking a local developer, in the case of Capital Land, a regional developer, which is Hong Kong Land and based obviously in Hong Kong, and a real estate investment trust, Capital Mall Trust being the largest of those 23 REITs. And as you can see in that 12-month period to March 2012, that more negative year, while the 2 real estate developers underperformed, in the case the regional developer underperformed the local developer, and then the real estate investment trust basically returned a small amount on the basis of that would have been on the basis of the dividend distributions. And then more recently in 2013, as you can see, the cyclicality of the market saw the developers return some of the gains that they had some of the losses that they had made, in the 12 months ending March 2012, and they still return quite different amounts, as you can see. So, just to look a little bit more into the sector stocks, there's as we say, we're looking at diversification very much in these examples from a sectorial point of view, where we're basically just taking educational examples, taking the largest capitalised stock of each of the sectors and showing you how it might have actually worked in the past, with, of course, no guarantees of what can happen in the future. But there are different ways to move the lens and to examine the diversification of the stocks. For instance, we are, as many of the marketing signs will show, an Asian gateway. We have a number of businesses and stocks and trusts listed on the stock exchange here that aren't just basically generating revenue in Singapore, not just basing their operational assets in Singapore, but in fact spread throughout the region in their activities. For instance, as we said, we have these 23 REITs. just over half of the 23 REITs actually do generate a significant portion of their revenue from overseas property assets, and we've got the list of those REITs here. This is available on a market update that we've recently conducted, and of course these market updates are all published on the CIAS page as well. So we have these 12 REITs, and as you can see, some of the REITs actually have all their property assets in overseas countries, such as Capital Retail China Trust. The most recent REIT to join the group is the Mapletree Greater China Commercial Trust. That was actually the biggest IPO of Asia in the first quarter of this year, and that's basically in that group as well, with 2 property assets, one in Beijing, a commercial property asset, and of course the retailing asset in Hong Kong. Then there's also REITs that have all their revenue in Singapore. But this is all based on their last annual reports available. You have REITs that are basically generating all their revenue, 8 REITs generating all their revenue in Singapore, and then some REITs that have small property assets outside of Singapore as well, Ascendus Capital Commercial and Case Logistics Trust. So the REIT sector is a very important part of the real estate sector of stocks that we have in Singapore. Would you believe that of all the STI stocks, you have 5 developers and you have 1 REIT represented in those 30 stocks? And if you look at the reserve list, now Hutchison Port Trust Holdings was recently added to the STI to replace Fraser and Eve, and Footsie Group, SPH and SGX will maintain a list of the 5 reserve stocks. But now there's only 4 reserve stocks because of Hutchison joining the STI. And those 4 reserve stocks are all real estate stocks. Real estate companies and real estate investment trusts make up the reserve list for the STI. So it is an important face of the stock market here in Singapore. As is consumer services. Would you believe that in the consumer services side of it, there's 5 consumer services companies that actually make up the STI as well, the part of the STI as well. Consumer services are typically retail stocks, they're media stocks, or travel and leisure stocks. In terms of the retail category, there's 2 major categories for the retail stocks. Now these are consumer services, not consumer goods. These are companies providing the services to end consumers, not to wholesale investors. These are such as Jardine Cycle and Carriage, which is one of the biggest stocks of the sector, the biggest I guess stock that's part of the STI for the sector, and it holds that 50.1% holding of Astra International, which is an automotive company providing automotive services to Indonesia. So there is quite a lot of service in this, obviously in this, and service is the key word for the consumer services sector. And think of it like SPH, which is the biggest stock of the media. That's really not providing goods, it's really providing a service and information service to end customers directly. And that exemplifies what really makes a consumer service stock. And we've got a list here of the biggest stocks that all have a market capitalisation above 100 million Singapore dollars. And as you can see, there's been quite distinct difference in price performances of these stocks within the sector. In the year to date, Bread Talk Group's been the outperformer, up 40% in price in the year to date, versus Informatics International, which has been the laggard stock and made a negative return of minus 24% over the year. So there's quite a diverse range of performances. There's different dividend yields. There's different market beta of the stocks as well, because of course market beta is important in comparing the volatility of the stock to the actual Straits Times Index in terms of what's happened in the past. Travel and leisure stocks are perhaps some of the most popular. Gunting Singapore, Singapore Airlines, ComfortDelGro. Many of these companies are obviously the top companies are household names, and half the stocks of the travel and leisure sector, the service, is actually made from hotels. here in Singapore. So as I said, beta was an important consideration because when you're looking at a stock and you're looking at the sector, you want to see how volatile this stock has been compared to the STI. And beta is a measure that basically allows you to see, let's say, for the last 2 years, on average, how is the variance of returns of the stock moved compared to the STI, i.e., on average, on a day-to-day basis over the last 2 years. If the STI was up 1%, what was the stock actually doing? Was it up or down 1.5% on average, or was it up or down only 0.5% on average, and therefore less swinging or less variant or less volatile than the actual STI? And if you take that line of 1 on that horizontal axis, you see Global Logistic Properties has a market beta of 1. So on average, it moved in tandem with this STI over the last 2 years. It's interesting because on the vertical scale, we've got dividend yield as well. And if you see, most of the stocks with the highest dividend yield are also low beta stocks. That is the Real Estate Investment Trust. The Suntec REIT, Capita Commercial, Ascendas. Capital More Trust should actually be up there. It's only because they had they basically split their dividend distribution period into 5 periods last year, and Bloomberg automatically take the last dividend distribution and then multiply that by 4, and that 0.8% dividend distribution that they had for the last month of 2012 was taken in the calculation as if that was the dividend distribution for the entire last quarter. So basically that's why that's a little bit lower on that end. But as you can see, between the 3 sectors of utilities, consumer services, the utility stock is SP AusNet, the purple marker there. As you can see in the 3 different sectors, you've got quite a wide range of dividend yield, and you've got quite a wide range of volatility history of these companies compared to the STI. Just to conclude, as we said, there's 5 consumer services stocks that do make up the STI: Gunting SP, Singapore Airlines, Singapore Press Holdings, Jardine Cycle and Carriage, and Comfort Delgro. And these are some of the these are the majority of the subsectors that actually make up the consumer services sector. And as you can see, there's 10 different actual business groups that are actually involved in the consumer services sector. Real estate, of course, the holding and developing companies are a large part of it. Is anyone familiar with the mid-cap index, the 50 stocks that come after the STI in terms of market capitalisation and size? So the all-share index, it's made out of 30 STI stocks, 50 mid-cap stocks, and the remainder of the small-cap stocks. The mid-cap stocks, the mid-cap index, is more than half of the weighting, half of the market capitalisation of the mid-cap stock is actually made out of real estate stocks. Thus, as you can envisage, your reserve list for the STI is largely made out of real estate stocks. So, as we saw, you can diversify the REITs by where the property assets are located. You can also diversify REITs by what type of property assets they are. Are they industrial property assets? Are they commercial property assets? Are they retail? Are they specialists such as healthcare and so forth? And in terms of utilities, the 2 key main utilities, water and electricity, they're basically the foundation for the utility sector. We have Hyflux is the biggest stock. Gallant Venture is actually categorised by the industrial classification benchmark into utilities. However, its recent businesses business endeavours and so forth would suggest it's probably shouldn't be in the utilities sector because of its changing shape of the business, which you can all be updated with, obviously, by going to the company disclosure page on the SGX website, which gives you a list of all the company announcements, and you can follow obviously you can look at the website of the company, the investor relations site, but the company disclosure site will show you how, if the company is making any acquisitions that might change the majority business nature of the company. So we definitely invite you and encourage you to use that website that web page on our SGX website. So I've shot over time by a couple of minutes, which I apologise for, and thank you very much for all your attention. As I said, email me if you want a copy of the slides. The real basic point of what I wanted to highlight in just this 20, 30 minutes or so was that we do have a very diversified stock market. Please be encouraged to use the resources, the educational events and the material that CUS is publishing. Please check out our website, SGX My Gateway, if you have not already. And of course, we CUS and SGX also have Facebook pages as well, if anyone is interested in visiting those places. All right, thank you so much for your time, and we'll see you again. Cheers.